All right, as mentioned, welcome to the first night of training for the technical aspects. Really want to try and make sure that we're doing a pretty good job of working with the materials that you have in front of you and walking you through some of the issues that you're probably going to be facing at the tax sites over the upcoming season. Obviously, we're looking here at the beginning of November. We won't see the first clients until probably 3 months from now. So I don't want you to try and memorize things tonight or try and view this as an opportunity to try and think that you're going to get all the answers. But what we want to try and teach you is the ability to access resources. So some of the best resources you're going to have are obviously the people working at your site with you. So if you have questions, don't hesitate to ask others that are around. But we do want to show you how to use the materials provided by the Internal Revenue Service. So for those of you who are preparing taxes for the first time, or for those returning volunteers that are coming back and saying, I think I've lost everything that I remembered from last year, not a problem, we'll go through all these issues. But just want to remind people that we have the opportunity to use these guides, these resources. You're going to be trained through our program. You're going to have access to Link and Learn and other tax areas. So what we're going to be taking a look at is making sure that you are feeling comfortable in terms of tax preparation. You'll be certified from the Internal Revenue Service, which allows you to go ahead and assist people in preparing taxes. The information that you collect from them is their information. Any answers that they give you, they're going to be responsible for. So don't worry that you're going to get into trouble and be putting down a position that's not valid. We're going to show you how to walk through the guides that you have, use the access materials provided in your 4012 on how to help make decisions. And so tonight what we're going to be doing is really taking a look at the whole situation of how do we determine who's going to be filing an income tax return and making a couple decisions about how that return is going to be filed. So we wanted to first start off with this whole process of who must file an income tax return. The main reason we want to start off with this chart is really just to kind of give you an understanding of how the income tax system is going to apply. The secondary reason is mainly for the fact that you'll probably need this information when you take your certification test. And the third reason is once you tell everyone you're preparing taxes, everyone's going to say, great, I have a couple questions for you. So we want to show you where to access this material in your guide. If you take a look at your 4012 on page A1, you'll see a chart that basically goes through who must file an income tax return. They're going to go through a couple different areas that we were going to be addressing here in terms of understanding what we're going to be looking at here from an income tax filing requirement. Really, we need to know about three things from an individual coming in for tax preparation. We need to know their filing status, which we'll actually be covering at the end of the session this evening. We'll need to know their age, and don't worry about it, you have to ask their age. Well, we do get that information. If you don't feel comfortable asking, that's fine. We're going to get a copy of their ID, so you can just slyly grab it off their ID. You don't actually need to ask them how old they are. But once we know their age, then we need to know what their gross income is. And what we talk about gross income is really what they receive in terms of financial benefit. The IRS defines income as any type of money, cash, property, other services received, as long as it's not exempt from income tax. And the IRS loves to use weird things in the English language. So I apologize. We'll probably go through some definitions. You'll probably hear more double negatives and the occasional triple negative that you've been told never to hear in the English language. We'll be using definitions. We'll use the same word to describe 7 different things. And that's perfectly fine in IRS speak, but we'll kind of walk you through what those issues are. So when we talk about gross income, what we're looking at are items of tax that are going to be taxable on a return. So when we're looking at things like gross income, it's going to be our traditional areas like wages, interest, any income from retirement. Things that are not included in gross income is generally Social Security, unless there's some specific areas. Generally, when we take a look at VITA clients, they traditionally have income less than $62,000 a year. That's including all sources of income. So unless they have significant amounts of Social Security income, that's not going to throw them into a filing position. The other things we're going to take a look at are there's some other items that are not taxable. Items that are not taxable include gifts, inheritances, those types of things. Insurance proceeds are typically not taxable if they're for recovery of a benefit or accident. So, but what we want to take a look at is understanding what type of income does this individual have, what's their age, and then what would their filing status be. And again, we're going to be covering filing status by the end of the evening tonight. So if we take a look at these things, we could actually use the 4012 to decide, should any of these clients file an income tax return? So if we went just through a couple examples, if we have Bob, who's 27 years old, single individual, and his gross income is $17,000 for the year. Would Bob have a filing requirement with the IRS? Yes, Bob would. He is certainly in that category where he's single, so he meets the filing status as single, he's under the age of 65, and his gross income is over $10,400. Bob would need to file. If we have George and Gladys, Gladys has just turned 66. Her husband George, just a little bit younger, robbing the cradle there at 64. They have a joint income together of $18,000. Would the two of them need to file an income tax return? They would not need to file an income tax return. What we're looking at is married filing jointly. We have one under 65 and one over, so they would need to be over $22,050 in gross income for a filing requirement. And if we have an individual, Joyce, who is a qualifying widower with a dependent child, her income is $23,000. Would she need to file an income tax return? Yes. So what we're basically just showing is a chart that you'll see populated within your 4012 and just some information how you can use those tools by identifying the filing status, the age, and then taking a look at gross income. So those are basically the issues of who has to file based on filing status and income. There are a couple other reasons that we're going to take a look that someone may have to file an income tax return. This is going to be on A3 of your 4012, Chart C. And this is basically people that would need to file an income tax return even if for some reason they fall outside of that chart. One of the biggest areas we're going to see is if anyone has net earnings from self-employment equal or greater than $400. It's a relatively low threshold, but if you have someone who's self-employed, someone who works on their own, whether it's something that they are doing some jobs on the side, they maybe have an outside service like babysitting, tutoring, lawn mowing, snow removal, personal care, any of those services, if they have more or greater than $400 of earnings, they would need to file an income tax return. One of the other situations we may run into is if someone has a distribution from a retirement plan. Typically, retirement plan distributions would be taxable. Again, we take a look at our primary chart to see if they have a filing requirement. The one issue we have is if someone has a non-qualified distribution, essentially an early withdrawal from a retirement plan, they would need to file an income tax return. If someone owes money for a recapture of credit, and these people already know who they are, don't have to worry that you need to identify them when they come into VITA, but they already know if they need to repay something like a first-time homebuyer credit, or if there's some education credits that they need to repay that they've been told need to come off their return. They will need to file a return. Probably the biggest one we're going to see is this very last one on our chart up here, and that's for anyone who may have received an advanced premium tax credit. We'll see a lot of individuals within the VITA system who may have purchased their own health insurance through the government marketplace. Anyone who's done so and has received an advanced premium credit will need to file an income tax return to basically reconcile the amount of credit they received in advance with how much income they actually earned for that year. So they will be reminded several times throughout the year that they need to file a return. This is just one of those requirements. Even if their income happens to fall outside the chart, they do need to file. So just a few other areas of who must file. So now we got the people out of the way that the government wants to see something from. Where are we going to be doing some benefit? Well, this is really who should file, and this is where we're going to see a lot of individuals who we can probably help out tremendously through the VITA program. This is actually going to be in Chart D on page A3. These are some individuals who otherwise would not be getting some benefits by filing an income tax return. The only way to get a refund from the Internal Revenue Service is to actually file a return to request one. Unbeknownst to most people, the government just doesn't decide, you could probably use some money, here's a check. That doesn't work that way. The way it works is that you need to actually file an income tax return. If you've had any type of withholding on your wages, and this can apply whether you are dealing with a client who happens to be retired and has a part-time job and they decide they'd like to do something on the side, and their employer withholds a little bit of income and some income tax. They need to file a return to get that money back. If you're dealing with a 15 or 16-year-old who has their first part-time job and they filled out their W-4 and their W-4 is having taxes withheld, we need to go ahead and file a return to get that money back. So the only way to get money back that's been withheld is you need to file a return. The only other way that you can get credits, and this is where we're going to see a lot of power in what the VITA program can do, is by providing money back to taxpayers who are otherwise entitled to get it. Some of the big ones we're going to see are the Earned Income Credit. The only way to get that credit back is to file an income tax return. The American Opportunity Credit. The additional child tax credit. These are all refundable tax credits. So even if a taxpayer doesn't owe any money to the government, they can still get money back. So these are incredibly powerful tools that we have at our disposal within VITA to help bring money back to the community. The only way these individuals are going to be getting the money that they deserve is by coming in and filing a return. So one of the things we want to take a look at is making sure we can get returns to the right people. One of the other areas we take a look at is we may have some seniors who otherwise do not have a filing requirement, but we do have a program here in the Commonwealth of PA. It's the PA Property Tax Rent Rebate. We can actually assist seniors in completing this form. So they can actually come into our site and we can actually provide them the documentation and forms that they need to send into the Commonwealth. And that can be a very nice benefit for them. In some ways, it can help pay for a lot of their expenses throughout the year. So in short, who do we file a return for? Anyone who comes in the door. If they have an appointment, we can probably help them in some way. The only way that they're going to get a refund is if we file a return. The only way that they can perhaps get some assistance in terms of filing for other benefits is by having an income tax return prepared for them. If anyone wants to file for FAFSA, for federal student loan activity, they're going to need to have an income tax return prepared. If they want to file for certain benefits, they should probably have an income tax return to demonstrate their income. So there are a lot of ways that we can help in preparation of tax returns. All right. Any questions so far on who has to file a return? Or who should file a return? Or why are we filing returns? Yes, sir.
On the chart before this one, you
Sure.
said, I don't need that.
Okay.
It says anybody with net earnings from self-employment greater than or equal to $400. What if you work on the side, you're listed as an independent contractor, you work for school districts, and you do not get a W-9 and don't exceed $600 that would require a W-9?
So the question is really kind of a two-part question. One is, if you have earned income, the IRS requires that you report income. The second part of the question is, what if someone does not report the income to you? That's kind of a separate question. If a 1099 is only required to be issued if you have $600 or more personal services rendered. If your provider fails to provide one to you, that theoretically does not preclude you from reporting the income. In fact, you should be reporting the income on your tax return. The IRS matching program will find anyone in which a 1099 has been issued that hasn't reported on the return. But even if it has not been reported, it's the obligation of the taxpayer to report all of their income. That's the official IRS answer. And in all cases, what we generally will do, we'll ask the individuals as they come in, do you have any income that you would like to report? We're still technically a self-reporting system here in the United States. We don't have a government agent watching over us as we deposit money into our accounts or pay for bills, but it is a process whereby it's a voluntary compliance with the Internal Revenue Service. They do have a non-voluntary compliance mechanism as well if someone chooses not to, but hopefully we're not going to go down that road. Okay, any other questions on taxes and who must file? All right, so one of the questions we're going to get into when we get into income taxes are really kind of just two main ones we're going to be talking about tonight. The first one is who qualifies for exemptions? Who's able to take an exemption off their income tax return? And the other one we're going to be addressing a little bit later as we go through some breaks and go through some examples is taking a look at filing status. The very first thing we started the chart off talking about. So the one thing we want to talk about exemptions is taking a look at who can claim a personal exemption on a return. And in general, everyone who files a return can claim one personal exemption for his or herself. The only exception is if someone is claimed as a dependent on someone else's return. The big area where we need to take a look at this is if you work at a site near a college campus. One of the things we take a look at is college students have a tendency to get their documents very early in the season. Generally, they may have a few part-time jobs, and they have an opportunity to say, I'd like to file my return. I want to be sure my FAFSA is all ready to go, even though you don't need this current year's anymore. It's still in the prior year. But they want to rush to get their tax returns done. The problem we run into is if you file a return for a college student, they say, not a problem. I claim myself on my return. I'm going to take myself as a dependent. Well, the problem we may run into is we're going to file that return early in February. By the time March, April rolls around and all of a sudden the parents try and file their return and they try and file a return using the kid as a dependent on their return, they get a nice little reject notice from the Internal Revenue Service saying, we're sorry, there's a problem with your return. Someone's already claimed a dependent on their own return. So usually at that point in time, we'll get a call at VITA and say, what in the world's going on? One of the things we just want to watch is to make sure that if you have someone who appears to be a dependent of someone else, if they're a college student and they say, well, I have a part-time job, but really from my perspective, I still have a residence at home, my parents still help out with the bills, they still help co-sign on loans, those types of things, we may want to double check. That's a good time to ask the student, would you mind just texting mom? She probably would love to hear from you. And in the text to say, yes, I'm still alive, just ask, by the way, am I being claimed on your return as a dependent? And that's going to at least have the conversation for us. So I just want a word of caution, particularly if you're working with someone who looks like they could be a dependent of someone else. We just want to verify that they are truly their own dependent before we take a personal exemption. If someone's going to claim them on a return, because they're entitled to be claimed on a return, we cannot take a dependency exemption for them. So we can't go ahead and take one for them. All right, so if an individual comes in and they're not being claimed as dependent on someone's return, they get a dependency exemption for themselves, or a personal exemption. If they're married, they also get a personal exemption for their spouse. Just be sure when you fill out a return that you're putting the spouse's name where it says spouse. You do not get to put the spouse under dependent. Spouses are never a dependent for tax purposes. Irrespective of how lazy your husband is, he's not a dependent. It goes under the spouse category for the purposes of the return. So if we have a return, we have two people that are married, we're going to see a taxpayer and spouse, we'll get two personal exemptions. Then we're going to take a look at this concept of dependency. People who could be claimed as a dependent on someone's return. The typical one we're going to be looking at here are children. People who are children of the taxpayers. They can either be living with the taxpayer, or perhaps they're a child who is living with someone else, but because of some custody relationship or because it may be a divorce situation, the non-custodial parent may be taking the child on the return. So there are a couple things we'll take a look at first with the dependency for a child. But then there are some other dependents, and these are where the rules get kind of interesting. So we'll kind of talk a little bit about where the two rules for dependency come from. So the first thing we take a look at are personal exemptions. So you get one for yourself. As long as someone else can claim you, you get one for your spouse if you're married. And then we'll take a look at those dependency rules. All right, so when we take a look at dependent, there are a couple things that we need to be sure are going to be in place before we can claim a dependent. So first, we can only claim a dependent if we're not eligible to be claimed as a dependent on someone else's return. So we can't have a chain of people that are all dependent upon someone else. So in order to claim a dependent, you yourself cannot be claimed on a return. The other thing we have to take a look at is the dependent has to be unmarried. Kind of makes sense. Hopefully if you're taking a 4-year-old child, they're not yet married. But we do run into some situations where we may see some individuals who perhaps have gotten married. We see this a little bit more in a military context where you have people who, before going overseas for deployment, decide to get married. You can still have a married dependent as long as they either don't file a joint return or they only file a joint return for purposes of a refund. The only reason I mention this is you may see this in the exam. You will rarely see this happen in VITA itself. But for the certification process, they'll ask you what are the rules for dependency. So the rules of dependency, you cannot be a dependent of someone else. You cannot have a dependent who's married unless they meet certain restrictions. So a couple other things we also need to take a look at. The dependent has to either be a U.S. citizen, has to be a U.S. resident, a U.S. national, which we found out the other morning happens to be someone who was born in American Samoa, is considered a U.S. resident, or I'm sorry, U.S. national, or they can be a resident of Canada or Mexico. So they don't actually need to be a U.S. citizen. As long as they reside within the U.S. or Mexico or Canada, they can be considered a dependent. There are some special rules for adoption. We don't often see those within the VITA program just because of the rules of adoption are a little bit more significant than what we typically see with our kind of gross income level of most of our clientele. But you can actually have some situations where an adopted child or someone considered for adoption can be considered a dependent. And then what we're going to get into is discussing two separate rules. The dependent has to qualify either as a qualifying child or as a qualifying relative. When we talk about qualifying relative, it has nothing to do with relatives. It's kind of an oxymoron. All right, so getting right into it here on C3 of your 4012, and just want to kind of show you what the guidance that we'd have to go through. So if you're taking a look at your 4012, it'll give you the indications of how do we determine whether or not someone qualifies as a dependent for a return. So we're going to be taking a look at those tests. One of the first things we take a look at is a relationship test. So the person has to be either the taxpayer's child. Okay, so far that sounds pretty good, right? If we're talking about qualifying child, we probably need to define what a child is. And I think most of us have some concept of child. If someone mentions child, you kind of have an idea in your mind of what definitionally a child would look like. The IRS is going to change that a little bit for you. So a child can be a taxpayer's child, it could be a stepchild, it could be an eligible foster child, it could be your brother or your sister. And now we start getting a little weird. How is it possible that your brother or sister can be a child of yours? Well, physically it cannot be possible. We're kind of redefining the laws of biology here with the IRS. But what the IRS is taking a look at is a position to say, we may have a unique family structure where you may have a group of siblings all living under one roof, and perhaps the parents aren't around for a couple reasons. Whether the parents just aren't alive, whether they're not in the picture, whatever the case may be. But you may have a situation where you may have an 18, 19-year-old individual as head of household, basically running a home for their dependent children, dependent siblings. If they're out working full-time and supporting the household, paying the rent, getting groceries, making sure the other younger children are going off to school, the IRS will allow that individual to claim their brothers and sisters as dependent children. So that's one of the reasons we're going to see this branch out to be more than just your own biological children. It's going to be your brothers and sisters, and there are going to be some caveats on top of that. It can also include your stepbrothers, stepsisters, or descendant of any of them. Which what we're taking a look at now is we're including any descendant of anyone I just mentioned. So we're talking children, grandchildren, great-grandchildren, great-great-grandchildren, and anyone descendant of your brothers or sisters. So your nieces, your nephews, your great-nieces, your great-nephews, anyone in those lineage fashions are all considered eligible to be your children for purposes of the tax code. We have a couple restrictions in place. One of the first ones is going to be an age restriction. So when we take a look at the age of the child, they first have to be under the age of 19. And the IRS loves to play these kind of number games with us. So rather than just say they have to be 18 or under, they like to say under 19. So mainly to confuse people to say, what number are we thinking of? So the IRS clearly defines it as under 19, which really in our minds means they have to be 18 or younger. Now there is an exception. So if the child is under the age of 24 and a full-time student, then that age bumps up. Now one of the other fun definitions, what does the IRS consider a full-time student? All right, if we mention full-time to most people, I think you kind of get the idea. Full-time, if I'm looking for employment, probably means somewhere around 32, 40 hours a week. Maybe get 2 weeks off a year for vacation, get a couple holidays. All right, full-time definition for the IRS says, all we need to do is get you at least a half-load credit for courses. So depending on the institution you're at, maybe somewhere between 10, 12 credits, maybe even less than that, depending on your institution. And we're thinking, okay, full-time. Full-time probably means most of the year, right? Well, full-time for the IRS means 5 months. Not 5 full months, mind you. Just any part of 5 months. So if we think about how a traditional college semester would work, if we think about a spring semester, students probably go back sometime in January, depending on when they go back to school, maybe mid-January. So we have about half a month of January. So you have all of February, all of March, all of April, and then they graduate at the very beginning of May, about a week or two into May. That is considered a full-time college student for purposes of the IRS. As long as they meet at least the half-time requirement for the student load, they are attending school for at least any part of 5 months, they're going to be considered a full-time student. So it broadens that definition quite a bit to see what we consider a full-time student. The last thing we want to mention about kind of the age restriction, if you have a situation where the dependent is totally and permanently disabled, and that's going to be coming from a doctor's certification, they can be any age. There's no age restriction, and in fact, they can actually be older than the taxpayer. I've worked with a situation in the past where we had a taxpayer and his wife, or I'm sorry, his sister was totally and permanently disabled. She was older than he was. He took care of all of her expenses. He made sure that she was in a home, took care of all her personal living expenses. She would still qualify as a dependent for him on the income tax return because of the fact that she meets that definition of the relationship, and there's no age test when it comes to totally and permanently disabled.
Is there a definition or certification to consider disabled?
What we're looking at for the purposes of disability, and that's kind of the question, totally and permanently disabled, is we're really kind of taking a look at functionality. Does the individual have complete functionality and the ability to have economic independence, if you will? Or there are some limitations in their ability to go ahead and have a standard of living that's going to be above the poverty level. It's really going to be kind of a doctor's certification to go through that process and determine if they're totally and permanently disabled. Sometimes you may see it in context with being awarded an SSI or an SSA award.
Yeah, so that's pretty clear that you awarded that. But if you're not, is it a judgment or do you need a certification from a doctor?
Yeah, typically in that case, if you don't have an award, you'd probably want to have a doctor's certification. Again, what we're going to do if a client comes into a VITA site and says, I have a child who's permanently and totally disabled, we're probably going to go ahead and claim them on the return as a dependent. If they bring some documentation, in most cases they probably will, to say here's a doctor's certification to say that they, the condition that they have that would qualify them to be totally and permanently disabled. But that's a great example of how we're going to use documentation provided by a taxpayer and say, based on the rules, based on the information we have, here are the restrictions. They have to have the relationship to you. We're going to take a look at a couple other tests as well. But as long as they meet those restrictions and they're totally and permanently disabled, then we're going to go ahead and take your word for it and treat them as a dependent on your return. Yep. Okay. Did that help answer the question? Okay, perfect. Great. So,
with parents, disabled parents, if you classify as dependents, and permanently disabled.
they could be dependents. They're not going to fall under a child. The IRS doesn't go quite that weird and say your parents can be your child. So we'll take a look at a relationship where they can actually be considered a dependent of yours, yes. So we can take a look at that. We do see some situations, not often within VITA, but you can be taking care of a parent and the parent can be considered a dependent of yours, just not under the qualifying child rules. Okay. I'm sorry, yes, Herb.
Did you say the SSI card would be evidence of permanently disabled?
Traditionally, it's one of the areas we could take a look at. If someone has an SSI card, meaning that they're getting some sort of benefit, they've already had a determination by a government agency that there's a disability, that can help indicate whether or not they're totally and permanently disabled. Again, we'll kind of rely on the taxpayer information if they've gone through that process. Yeah. But if they have an SSI card, that's probably going to help us with it. From that standpoint, if the taxpayer gives us the information, that's generally all that we really need. And we can remind them of the rules to say, just to kind of let you know, we'll help you prepare the return. The IRS may come back and they're going to be the ones ultimately asking about the totally and permanently disabled. So at that point, if they can show either a doctor's certification, if they come to a site and they say, oh, I left the letter at home, we're not going to hold up the process and say, oh, by the way, I have plenty of time. You just run home and get the letter and come back. Or I'll stop where I'm at and go ahead and just, take someone's time 2 weeks from now when you bring the letter. We'll kind of work on the information that they bring us, and if it seems honest and valid, we'll kind of work with it. Basically what we try and believe is we have a fairly trustworthy base of clientele within VITA. And I think what we've seen, a lot of the returning volunteers that are here, please, if you've seen these situations where it's been any different, let me know. But a lot of the clients come in and they have a good understanding of what kind of they're facing here. So if there are any questions that they have, we can either talk to them with it. If you have any questions, you can always talk to your site coordinator and kind of come up with a decision at that point to determine whether or not it seems the right thing to do. Okay. Any other questions so far on kind of age or disability? We'll kind of hit a few more things here in terms of what we need to look at for dependency. One of the other things we need to take a look at is making sure that they live with the taxpayer for more than half the year. The one thing the IRS does get down pretty well is this whole concept of more than or less than. They're pretty good at that. They know someone less than 19 has to be 18. They're pretty good at more than half the year, means that only one person should be able to qualify in that context. We kind of started off this whole definition with the child being a relatively broad universe of people that could claim a child. But when we talk about more than half the year, what we're looking at is only one person probably qualifies in that definition. You can't be living with your grandmother, your uncle, and your parent for more than half the year unless you're all under the same roof. So that's going to limit a couple people in terms of who can take a dependency exemption. One of the other unique rules is they cannot provide more than half of their own support. So the IRS doesn't care where the money comes from to support the child, as long as the child themselves do not provide more than half their support. So if you have a child who's out, happens to be a Gerber baby, and makes a ton of money doing modeling or advertising, and they get a lot of money paid to them for those services. If that money's put aside and not actually spent on their food, clothing, education, that's not considered support. The parents are actually the ones still providing the support for the child. If the child's actually getting things like Social Security benefits and using those toward their own support, generally Social Security benefits are going to be treated as being provided by the child. If you have any questions with that, that'll actually be at the bottom of C3 and some footnotes. Any state payments that they're getting, any type of financial aid from a state agency, is traditionally not considered support from the child. So if they're being supported by the state, if they're getting food or housing assistance from the state, that's not considered support paid by the child. You can still take a dependency exemption even if the child is getting state benefits. One of the things we did talk about before is essentially the child cannot file a joint return. Again, most situations within VITA, we're talking about children. We don't see a whole lot of 5-year-olds coming in, getting a dependency exemption, and then asking, hey, can I file with my spouse? Maybe they have a special friend in preschool that they think they're going to get married to, but they're not legally married yet. They're not going to be filing their own return. Again, we may see some situations where you may have some older children. Again, I've seen this a little bit where we have had military deployment, and you have someone who decides to get married before their boyfriend, girlfriend goes overseas, and they're still living at home, and they're going to be filing a joint return just to go ahead and get a refund. So you can still file a return with your spouse and still be dependent on your parents' return. The other thing we want to take a look at, again, this definition is fairly broad for qualifying children. So we want to be sure that there's no one else that can claim that child under what we call the tie-breaking rules. And the tie-breaking rules are going to be found on C4 of your 4012. Yes, question?
Before we move off of C3, on the child having lived with you more than half a year, tests on the right-hand side give an income limit. So if the child is a student close to 24, might have graduated, has been at home, but then finds a job close to the end of the year and has some income,
Yep.
if they exceed that 40/50, then they're on their own.
Well, yeah, and that's kind of a unique situation. So the kind of the question involves kind of that child graduating from college. And so technically they're still going to meet the definition of a qualifying child, because as long as they haven't hit the age of 24 yet during the year, they can still be a qualifying child. So we don't even have to go over yet to the qualifying relative test yet, as long as they're still going to meet some of those definitions. Yeah, so the qualifying relative is going to have an income limitation threshold. But as long as they still meet the qualifying child test, that's fine. And you bring up a great point about kind of those temporary absences. So if a child is off at school, education counts as a temporary absence. Living with another relative for vacation or other purposes counts as a temporary absence. If you have a child who decides to take vacation for 8 months out of the year, that's a temporary absence. If the child is incarcerated, that's a temporary absence. So any of those temporary absences aren't going to count against you that they're not actually living in your home for more than half the year. But we do get to some of those very interesting issues about someone who graduated college and what's their relationship look like for that first year coming out of school. Are they still a qualifying child and could be a dependent of their parents? Or have they earned enough money at the end of the year that they're probably providing more than half their support and should be a dependent on their own? And so that's some of the areas that we take a look at. And that's probably going to come down to who's actually paying their support. If they graduated, they're still living at home, they're working toward a full-time job, then maybe they're still going to qualify as a dependent of their parents because they haven't yet provided more than half their own support. Okay. Did that help answer the question? Okay, perfect. Okay, so just a couple things we want to take a look at those tie-breaking rules. How do we determine if more than one person wants to claim a child? And I'll tell you, the easiest way you want to get correspondence from the IRS is have multiple people try and claim the same child. That's a guaranteed way you're going to get a nice little IRS correspondence program. But what we're going to take a look at is how can people determine who's supposed to be claiming a child? Well, we go through a bunch of rules. We just talked about relationship tests. We talked about the residency test, that they have to live with the taxpayer for more than half the year. The child can't provide more than half their support. But what if we have multiple people that try and claim a child? What if we do have 3 or 4 generations living under one roof? What if you leave your Social Security cards out on the table one day and an uncle walks by and says, that looks like a refund to me. I'll go ahead and take that Social Security card and try and file. They're entitled to. It's part of the relationship test. But what we want to try and take a look at is who actually should be claiming. And the IRS is going to come up with a tie-breaking table that we have here on C4. So the first test we take a look at is if only one of the people trying to claim the child is the child's parent, the parent's going to win. The IRS defaults back to whoever the parent of the child is the primary person that can take that individual as a qualifying dependent. Now, the other situation would be, what if we have 2 parents who are trying to claim? The IRS puts this very weird context in here to say you cannot file a joint return and fight over who's taking the child as a dependent. Not quite sure why, because it ends up on the same return anyway. There's no designation to say spouse or taxpayer is taking the child. It's going to be on the same return. But if you have a situation where you have a couple that's no longer together and they're both trying to take the child as a dependent, the IRS is going to take a look at who did the child live with more. Who had the child for the greater amount of days. The nice part about 2017 is a non-leap year. We have 365 days. There should hopefully be one that has a greater amount than the other. There are some very bizarre circumstances where somehow we're exactly on half time. But if you say we have 1 month on, 1 month off, 1 week on, 1 week off, whatever the case may be, we're probably still going to have someone who has more than half the year. But if for some reason we end up with exactly the same amount of days, the next thing we take a look at is it's going to go to the parent who has the highest adjusted gross income. Whoever has the highest amount shown on their income tax return in terms of gross income is going to be the one that gets to claim the child. Now, what we're going to take a look at here is if no parent claims the child. So if the parents aren't trying to claim the child at all, now we're looking at maybe grandparents or siblings or aunts and uncles trying to take a child, it's going to go to the person who has the highest adjusted gross income. So whoever has the highest amount of money is the one who's going to be eligible to claim that child as a dependent. The other interesting part we have is the IRS actually understands that there may be situations where a parent may have been eligible to claim a child as a dependent, but chooses not to do so. In some unfortunate circumstances, perhaps the parent is in a facility or not around, or maybe off at school or some other circumstances, and chooses not to claim the child. That's entirely fine. Another party may claim the child. So in that case, if a parent chooses not to claim a child, someone else may, as long as they meet the other rules. The only requirement is their adjusted gross income has to be higher than the parent's. So you can't waive it and try and shop your child around and say, I don't want to claim it, who wants to take a dependency exemption? I have too many kids, who needs one? You can't do that. But as long as the AGIs are higher, whoever has the highest AGI can go ahead and take that child as a dependent. Okay, do we thoroughly confuse everyone on what a child looks like? They still look the same. They're these little things running around, not quite full adults yet. But the definition of who owns that, or not who owns the child, that seems really odd. Who actually can claim the child is much, much different. So a lot of difference there in the relatives. Okay, so one of the things we take a look at is if we don't meet a qualifying child test, then we can go to this other test, this qualifying relative. The main thing to keep in mind is the qualifying relative test comes only after the qualifying child. The qualifying child test is going to trump anything else. That's the first test we need to go through. If a dependent falls under a qualifying child, we stop there. We can't move them from qualifying child into qualifying relative. But if someone is considered a dependent and they don't meet the qualifying child test, maybe we can see if they meet the qualifying relative. And I think this is going to your question about what happens if we're taking care of parents. So now we take a look at broadening a definition. And the IRS loves to use these definitions. Okay, so let's start off with what a relative is. The very first definition we have up here of relative is someone who's not even related to you. Kind of blows out your whole definition of relation, right? I mean, if you're talking about relative, it's someone who probably is in your ancestry profile. But the first thing we're going to say is they don't even have to be related to you. They just have to live with you for the entire year. So it has to be a member of your household for the entire year, January 1st through December 31st. So if you have a friend who would like to crash at your place for a couple days, make sure they're in before New Year's Eve. And if a couple days stretches into about 10 months, say, hey, you don't need to leave right away. Why don't we have you hang out here until the New Year's ball drops again, then you can get kicked out. If you keep them for the entire year, not without their consent, obviously, but if they stay for the entire year, they can be considered a qualifying relative, as long as it's not prohibited by local law. I'm sorry, yes, question.
Don't you have to prove that you paid 50% of their upkeep?
Sure. Yeah, and the problem that we have with the charts is we kind of start the wrong way on the charts. The chart kind of gets you all excited because, oh wow, we can actually maybe take someone who's been living with us, someone who's been a relative of ours. But the main thing we have to take a look at is there's two contexts that we're going to take a look at. And these are kind of the bottom ones here. First of all, the taxpayer themselves have to provide more than half the support for that individual. The qualifying child test, all it said was the child could not provide more than half their support. Now we've changed this to say the taxpayer has to provide more than half that individual's support. The other problem we run into is this caveat here. Their gross income has to be less than $4,050. So if you have someone staying on your couch all year long, and they say, I'd like to go get a job, and I think I can make $5,000 a month. What you want to say is, how about if you start that job on December 15th? That'd be a great time for you to start. Because that way you're still under $4,050. I'm not going to pay for all of your groceries, all your expenses, your cell phone, your clothes, and not get a deduction for you. I'm going to go ahead and take you as a dependency exemption. So the 40/50 is kind of a big kicker there for that process. Yes?
If I have a 28-year-old daughter who lives with me, she qualifies as a qualified relative.
Yes.
With no income.
Correct.
Now, but if she wants to claim the education credit, she has to do her own taxes.
Right, so some of the things we take a look at are how do we kind of take that education credit in context with the dependency exemption. Now, for the fact that she doesn't have any income may depend on how much of that credit she can actually get. So the American Opportunity Credit, which we'll talk about at credits, is partially refundable. But it may make more sense if she doesn't have any income and you would technically have the ability to claim her as a dependent, that she doesn't take the credit, but instead she allows you to take her as a dependent and also take the education credit. And
That's my next question.
yes,
I think that.
sure, yeah, absolutely. If you take her as a dependency exemption, you could take the education credit for her. Yep. And you're jumping right to the chase here. The big thing is you have to provide more than half the support of the taxpayer, of the potential dependent, and their income has to be less than $4,050. That's kind of our big issue that we take a look at. It's a relatively low threshold. But the interesting part, that definition of relative expands even greater. We thought the child seemed kind of odd, that your brother and your sister could be your child. But now we're going to take a look at qualifying relative. And qualifying relative is essentially saying it's going to start with those same type of things. Child, stepchild. It's going to be foster child. It's going to be your grandchildren, great-grandchildren, your brothers, your sisters, your stepbrothers, stepsisters, half-brothers, half-sisters. It's going to be your fathers, your mothers, your grandparents, your great-grandparents, any other direct ancestors that you have. So you can go all the way up the family tree for as many generations they're still there. Just foster parents don't count. The other thing we can take a look at, it also means any stepmothers, stepfathers, in-laws count as well. So your mother-in-law, make sure you get her social security number if she's staying around the house for a long period of time. That could potentially count as a dependency exemption. So uncles, aunts, brothers-in-laws, all those other things can count. The only things that don't count are cousins. Somehow in the grand scheme of things, we've just put together an entire ancestry DNA profile, but we're kicking out all the cousins because they're actually descendants of your brothers and sisters. They're not actually descendants, or they're descendants of your aunts and uncles, not of kind of your family lineage. It gets a little weird. But leave it to the IRS to decide what they think is appropriate genealogy. Eventually they'll probably turn it over. And I'd love it if that's the case. If you just went to Ancestry DNA and said, who could be a potential dependent of mine? That'd be a great situation we'd have. Pull up all the list of people who haven't been claimed on a return yet. So you may want to go Facebook message them and say, what's your social security number and birth date? And how much gross income did you have? But again, what we need to take a look at, you have to provide more than half their support, and their gross income has to be less than $4,050. Okay, how are we feeling on dependency exemptions? As long as you follow the charts. So if we take a look at C3 for the qualifying child, C6 for the qualifying relative, make sure that you go through those methodologies. If someone's a qualifying child, they need to stay in that dependency exemption status. If they're not a qualifying child, then we can move on to qualifying relative. And then we get to have some unique issues about how should they be filing. All right, so with that, I think what we'd like to do is take about a 5-minute break. Ezra, I'm sorry, question. Oh, I'm sorry, question, yes. Mm-hmm.
It's the parent that the child lives with, but what is the shared custody and how is it determined what part of a day qualifies for that parent?
Right, so the question again is basically kind of going back to we have a child being claimed by both parents. So the issue the IRS is going to take a look at is they're going to say, tell us who the child lives with the most. And you do run into issues to say, when does that transition happen? How do we count the number of days? And the IRS has some guidance on how that's going to be calculated. And we may run into some issues where it may be a little tight on whether or not we actually can prove one way or the other who has more than half custody. Because what they're going to probably take a look at is someone may argue to say, well, I picked them up at noon, not at 4 o'clock, so I have them for the majority of the day. Well, the IRS is going to take a look and say, well, let's get as close as possible. In most cases, we're not probably exactly half. We may get close, depending if we do an every other week type situation or things along those lines. But if they're that close, the IRS is probably going to say, let's just go with whoever has the highest AGI. So we won't get down to the minutia and say, let's split exactly 365 down the middle, and we're going to fight over a couple hours. If it gets that close, we're probably just going to take a look at an AGI test. In a lot of contexts where we see that we may have parents of children and the parents are no longer together, it's generally easier if we have kind of an agreement between the parents of who gets to take the child for that period of time. So a lot of times if we have a divorce situation, that's already going to be specified in the divorce agreement. The best thing we can do if we have a non-custodial parent is that hopefully their former spouse is signed off on their dependency waiver. Basically a form that they're going to sign to say, I'm going to waive my dependency rights for the child under these specific years, under the terms of our divorce. So if you can get to an arrangement before both parties try and file, that's a whole lot easier. Otherwise, what may happen, and the situation may arise, you may be preparing a return within VITA, and someone says, I'm going to claim my child, I've had them for 10 months out of the year, and I'd like to take a dependency exemption for my child because of the other benefits that go with it. You go to file the return, all of a sudden we get a reject notice from the return saying that dependent information has been used on another return. And maybe the other parent had already claimed the return and filed first. That doesn't preclude us from filing that return. We can still do that with a paper filed return. We're just going to let the taxpayer know, by the way, do you want to go to battle not with the IRS, but you want to get the IRS involved in sorting out the custody issue. Because the IRS will make a determination if more than one person tries to claim someone on a return. And then they'll basically be part of a letter process, and they'll both get a letter saying, please submit the information why you believe that you're the appropriate party to claim the child as a dependent.